Silver investors, right now this metal is acting like the drama queen of commodities. One day it looks like it's about to explode into a once-in-a-decade rally. The next day it feels like a cold, calculated trap set by patient bears who are just waiting for late buyers to over-leverage and panic. Today I'm going to walk you through the real silver setup, not just price, but macro, green energy, the dollar, and sentiment, so you can decide for yourself. Is this the start of a legendary silver opportunity, or is it a painful trap for people who jump in without a plan? No signals. No VIP group, just the full picture so you don't walk into this market blind. We'll break it into 5 parts: the macro engine, Fed, rates, inflation expectations, and the shadow of the 1970s. Industrial demand from the green transition, key context tools, gold-silver ratio, dollar, sentiment zones, risk management, how to touch silver without blowing up your account. Let's start with the macro engine, because every silver move starts there. Segment 1, the macro engine behind every silver move. Silver is a weird hybrid, half monetary metal, half industrial workhorse. That means it doesn't just care what's happening in mines or factories. It cares about what Jerome Powell says at the podium, what the Fed does with interest rates, how the dollar trades against every other currency. When the Fed is holding rates high and talking tough on inflation, the US dollar tends to stay strong. Real yields, nominal yields minus inflation, are high. In that environment, silver usually feels heavy. Bounces get sold, rallies fade, and the chart looks like one big choppy range. Why? Because a strong dollar makes silver more expensive for everyone outside the US. High real yields make bonds and cash look more attractive than a metal that doesn't pay interest. But the tone is shifting. We're now in a world where headline inflation has cooled off the peak. Growth data is wobbling between okay and tired. Markets are starting to price the next big Fed move as a cut, not another hike. Even just the perception that the hiking cycle is done breathes oxygen into precious metals. Gold starts to grind higher. Silver, as the more volatile cousin, doesn't just grind, it swings. The real driver is real yields. When real yields fall because inflation is sticky while nominal yields drop, or because the Fed signals cuts, the opportunity cost of holding metal goes down. That's exactly when capital starts hunting for hard assets as long-term insurance. That's the macro engine where silver can go from boring range to headline move very quickly. Segment 2, inflation expectations and the shadow of the 1970s. Even if official inflation prints cool, the fear of a second inflation wave never really dies. Why? Because energy prices can spike on war or supply issues. Shipping lanes can get disrupted. Geopolitical shocks can hit supply chains out of nowhere. Investors remember the 1970s, oil shock, stagflation, real assets ripping while fiat purchasing power bleeds. In that psychological environment, silver plays a very specific role. It's poor man's gold, the metal you can stack in ounces without spending a fortune on every coin. Whenever inflation expectations perk up, online silver stacking content spikes. YouTube thumbnails scream currency collapse. Own real metal, paper is worthless. TikTok and Instagram fill with bar and coin flexes and safe haven narratives. On its own, that retail behavior isn't huge in dollar terms, but it is powerful kindling. It keeps silver in the conversation. It builds a base of emotionally committed holders. So when institutional money finally rotates in, there's already a fire to spread. That's why silver can do nothing for months and then suddenly move 20-30% in what feels like one breath. The emotion was building the whole time. You just couldn't see it on the chart. Segment 3, industrial demand. Green energy turns silver into a strategic metal. Now the second pillar, and honestly the one most people still underestimate, industrial demand, especially from green energy and tech. Silver is indispensable in a modern electrified world. Solar panels, photovoltaic cells use silver paste because its electrical conductivity is elite. Governments are pushing massive solar installs to hit climate targets, so solar remains a structural demand monster. Electric vehicles, EVs. EVs are basically computers on wheels. They need sensors, control systems, power electronics. Everywhere you look, silver's conductivity and reliability are in the design. Electronics and 5G. The more we connect everything, phones, devices, industrial IoT, the more the electronics complex grows. Silver has a permanent role here. Emerging tech, high-efficiency batteries, medical devices, clean tech prototypes. Silver keeps popping up in schematics and patents. Now combine that with the supply side. New mine supply cannot double overnight. Big deposits are harder, deeper, more expensive. Permitting and environmental rules slow everything down. So you have a long-term tension. The world wants more silver for infrastructure and devices faster than miners can safely and profitably pull it out of the ground. That kind of structural squeeze is exactly the type of story that can sit in the background for years and then suddenly become the main headline when investors connect the dots. That's what turns silver from a nice diversification idea into a strategic commodity for the green transition. Segment 4, the gold-silver ratio, the old school signal whispering undervalued. Now let's talk about one of the oldest context tools, the gold-silver ratio. This ratio tells you how many ounces of silver you need to buy 1 ounce of gold. Historically, when the ratio is very high, silver very cheap relative to gold, it has often preceded periods where silver outperforms. Right now, according to the ad hoc piece, the ratio is still in a historically elevated zone, not at the absolute craziest extremes, but definitely in an area where silver is undervalued versus gold makes more sense than silver is fully priced. What pros do with that? They don't use it as a precise timing tool. They use it as context. If gold is supported by macro, Fed, inflation, risk-off, the gold-silver ratio is high, then the odds favor a catch-up phase where silver starts to move harder than gold. So if gold quietly grinds higher and silver keeps lagging, the spring is winding tighter. When sentiment finally flips, that tension can get released in violent silver moves. Segment 5, the dollar. Why its swings hit silver so hard. Next big piece, the US dollar. Silver is priced in dollars globally. That means strong dollar, headwind. Weakening dollar, tailwind. In a strong dollar regime, non-US buyers see silver getting more expensive in local currency. Macro funds prefer yield-bearing assets, bonds, over non-yielding metals. Silver tends to chop, get sold on strength, and frustrate bulls. In a weak dollar trend, silver becomes cheaper globally. Demand can pick up. Asset allocators are more willing to add metals to diversify away from fiat risk. Right now, according to the article, the dollar is no longer in full runaway strength mode, but it's also not in a total collapse. It's in a balancing act, relatively high US yields versus the possibility of future cuts. From a tactical standpoint, silver bulls want to see the dollar lose momentum steadily, not spike on every data release. Persistent dollar softness is how you turn silver's current choppy action into a more directional uptrend. So if you're watching charts, silver by itself can fake you out. Silver plus gold-silver ratio plus dollar trend gives you a clearer map. Segment 6, green energy, the silent megatrend underneath every dip. Let's zoom out again. The world is mid-transition, from fossil fuel dependence to electrified, digital, always-on infrastructure. That means more solar farms in deserts, on rooftops, in industrial parks, more EVs built every year, more data centers, 5G networks, and smart devices. Every one of those needs silver. Yes, engineers will try to thrift silver usage per unit. They'll optimize paste, coatings, and designs. But the number of units is exploding, so total aggregate demand for silver stays robust, and in many forecasts rises significantly over the next decade. That's why the article calls green demand a silent mega trend. It doesn't show up as headlines every day, but it is there in the background, adding pressure every single year. If policymakers double down on climate targets, subsidies, EV mandates, grid upgrades, they're indirectly doubling down on silver demand. Segment 7, sentiment, fear, greed, and the ghost of silver squeeze. Now, the emotional layer. Silver is uniquely explosive on sentiment. We still live in the shadow of the 2021 silver squeeze attempt. Wall Street bets threads, viral posts about COMEX running out of metal. Social platforms are still packed with stackers showing off their latest coin and bar hauls promising never to sell. Macro doomers talking about debt, currency debasement, and the need for hard assets. Short-term traders hunting for breakouts, fakeouts, and liquidity pockets. When fear is high, safe haven flows bleed into silver. When greed returns, momentum traders rotate into volatile, leveraged plays, and silver qualifies. Whale activity, big players, doesn't post TikToks, but you can see footprints in futures open interest, options positioning, ETF flows. When those start rising during an up move, it usually means larger capital is stepping in. That's when trends can become more persistent, not just random spikes. Right now, the vibe is cautiously optimistic but unstable. Bulls are loud, bears are skeptical, both sides are ready to jump on any macro surprise. That mix equals volatility, great for traders, dangerous for overconfident investors. Segment 8, key trading zones, the battlefield between bulls and bears. The article stays in safe mode and doesn't quote exact numbers, but it describes the structure well. Silver is oscillating between important zones where past rallies stalled and past sell-offs found support. Think of it like this. There's a ceiling, the breakout zone where if price finally rips through with volume, breakout traders and FOMO buyers will pour in. There's a floor, the area where dip buyers defending the long-term thesis keep stepping up. Between those, you have a battlefield. Bulls' arguments. Green energy megatrend is real. Fed will eventually pivot. Gold-silver ratio still favors silver. Silver is still historically undervalued relative to gold. Bears' arguments. Dollar could stay stubbornly strong. Fed cuts could be delayed. Industrial demand could get hit if global growth slows. Silver's volatility traps late buyers who chase spikes. The tape right now reflects that tug of war, not a clean, calm uptrend. A series of emotional pushes and pullbacks. That's why you can't treat silver like a slow blue chip. It doesn't move that way. Segment 9, Risk Management, How Pros Touch Silver Without Getting Wrecked. If you remember nothing else from this video, remember this segment. Silver is a high beta, high volatility asset. It punishes sloppy risk management. Pros handle it like this. Position sizing. They size silver smaller than slow FX pairs or large cap stocks. They assume the metal can move 2-3x faster than gold on a percentage basis. They avoid max margin on pure conviction. Clear time horizon trader or stacker. Pick one per position. Traders focus on intraday, short-term zones, liquidity, order flow. Long-term investors focus on multi-year deficits, green demand, Fed cycles. Mixing time frames in one position, swing trading with retirement money, is how people get shaken out at the worst possible moment. Invalidation. Traders have levels. If price closes below X, my idea is wrong. I'm out. Investors have macro conditions. For example, if real yields stay very high and industrial demand collapses for 18 to 24 months, my thesis needs a rethink. Diversified exposure. Some divide between physical silver, slow, no leverage, long-term hedge, ETFs, easier to trade but still equity market risk, derivatives, CFDs, futures, options, fast, flexible but dangerous if misused. Derivatives are for precision and speed, not for core allocation. Physical is for survival and conviction, not for quick flips. Segment 10. Who silver is for, and who it will destroy. According to the article, silver makes sense for 3 types of people. Macro hedgers. You see fiat risk, debt loads, and potential stagflation. You want a hard asset sleeve against a weaker dollar or more inflation over the cycle. Green trend believers. You are convinced the world is not going backwards on electrification, solar, and EVs. You see silver as a key input into that build-out. Active traders who respect risk. You like volatility. You have rules. You are not afraid to cut losers and take partial profits. On the other side, if sharp drawdowns make you panic, if you over-leverage on conviction, if you never predefine how much you can lose, silver will eat you alive. It is not a metal that forgives emotional trading. Segment 11. Opportunity or trap? The honest answer. So, is silver about to unleash a massive opportunity or a painful trap for late buyers? The honest answer is it can be both, depending on how you approach it. Opportunity side. Structural deficits and green energy demand are real. The Fed will not keep real yields elevated forever. The gold-silver ratio still suggests silver has catch-up room over a full cycle. If macro lines up, softer dollar, easier Fed, persistent green capex, silver has the potential to outperform gold and many other assets. Trap side. A stubbornly strong dollar, a Fed that delays cuts longer than the market expects, a sharp growth slowdown that hits industrial demand before easing arrives, late buyers piling in with leverage because of hype, not because of a plan. The article nails it in one line. Professionals treat silver as a high-octane sleeve of a broader portfolio, not a one-asset religion. If you respect the volatility, size correctly, separate trading from stacking, silver can be a powerful opportunity. If you ignore macro, chase hype, and bet big, because you saw a thumbnail saying $500 silver tomorrow, then yes, it's a trap, and you are exactly who the other side of the trade is waiting for. Use silver with discipline, stack smart, trade sharp. And never forget, volatility is the enemy of impatience, but the best friend of the prepared.